Second quarter GDP outcomes for most economies have been massively negative as expected. At this stage, third and fourth quarter recoveries for 2020 are expected to be robust. However, the pace of growth in 2021 could be modest, depending on control of new virus outbreaks, the extent of supply and demand losses, and future growth in investment and productivity. Volatility in financial asset prices remains high. As virus developments and geopolitical events continue to impact heavily on market sentiment. While capital flows to emerging markets have generally picked up compared to the outflows experienced in March and April, the global environment continues to reflect pronounced levels of risk aversion. Policy responses to the crisis have generally been robust across countries. In recent months, many fiscal and monetary authorities have opted to wait for new data to gauge conditions and assess the speed of economic recovery before making further adjustments. The COVID-19 outbreak has had major health, social, and economic impacts, presenting difficulties in forecasting domestic and global economic activity. The compilation of accurate economic statistics has and will remain severely challenged. On 8 September, Statistics South Africa released their estimate of second quarter growth in GDP and revised the first quarter figure slightly. As expected, output was severely negative, with seasonally adjusted and annualized quarterly GDP contracting by 51% across all sectors except agriculture, which expanded. The bank now forecasts a GDP contraction of 8.2% in 2020 compared to the 7.3% contraction forecast in July. The second quarter is followed by revised projections of a stronger expansion in the third and fourth quarters of 2020. Further easing of the lockdown has supported economic growth. High-frequency indicators generally show a pickup in economic activity from extremely low levels in April and May. However, getting back to pandemic output levels will take time. With a sharp decline in investment, potential growth estimates have been lowered, resulting in smaller output gap over the forecast period. GDP is expected to grow by 3.9% in 2021 and by 2.6% in 2022. South Africa's terms of trade remain robust. Commodity prices are high, while oil prices remain generally low. The price for Brent crude oil increased between July and September and is expected to average about $42 per barrel in 2020, rising to $47 per barrel in 2021 and $52 per barrel in 2022. The rand has depreciated by 15.8% against the US dollar since January and remains below its estimated long-run equilibrium value, despite considerable appreciation since June. The implied starting point for the rand forecast is 17 rand 7 cents to the US dollar, compared with 17 rand 93 cents at the time of the previous meeting. Risks to the growth outlook are assessed to be balanced, but this is tentative and open to adjustments given the wide range of shocks hitting the economy. Uncertainties involving the effectiveness of policy and the sensitivity of sentiment to news flow. The exceptionally accommodative policies in many advanced economies and improved economic outlooks have supported a partial recovery in global financial markets. But this has so far resulted in only a trickle of fresh capital flows to emerging markets, and financing conditions remain uncertain. The sharp rise in South Africa's public financing needs arising from falling tax revenue and higher spending has been financed by higher private sector savings and borrowing from international financial institutions. Resident investors, including banks, have increased purchases of sovereign bonds, helping to ease yields in recent weeks, alongside the SABC's liquidity management operations. However, the yield curve remains exceptionally steep, reflecting ongoing credit risk associated with high public borrowing needs. The bank's headline consumer price inflation forecast averages 3.3% in 2020 and is lower than previously forecast at 4% in 2021 and at 4.4% in 2022. The forecast for core inflation is lower at 3.4% in 2020 and remains broadly stable at 3.7% in 2021 and 4% in 2022. The overall risks to the inflation outlook at this time appear to be balanced. Global producer price and food inflation have bottomed out. Oil prices remain low. Local food price inflation is expected to remain contained. Risks to inflation from currency depreciation are expected to stay muted while pass-through remains low. While there are no demand-side pressures evident, electricity and other administered prices remain a concern. Additional exchange rate pressures could also result from heightened fiscal risks. Importantly, expectations of future inflation continued to soften this year and have shifted slightly below the midpoint of the band for 2021. Market-based expectations for short and medium-term inflation have eased slightly, while longer-term inflation expectations remain higher. Despite a higher-than-expected inflation outcome in July and elevated levels of country financing risk, the committee notes that the economic contraction and slow recovery will keep inflation below the midpoint of the target range for this year. Barring risks outlined earlier, inflation is expected to be well contained over the medium term, remaining below but close to the midpoint in 2021 and 2022. Against this backdrop, the MPC decided to keep rates unchanged at 3.5% per annum. Two members of the committee preferred a 25 basis point cut, and 3 members preferred to hold rates at the current level. The implied policy rate path of the quarterly projection model indicates no further repo rate cuts in the near term, and 2 rate increases in the third and fourth quarters of 2021. Monetary policy has eased financial conditions and improved the resilience of households and firms to the economic implications of COVID-19. The bank has taken important steps to ensure adequate liquidity in domestic markets. Regulatory capital relief has also been provided, sustaining lending by financial institutions to households and firms. The committee's view remains that monetary policy cannot on its own improve the potential growth rate of the economy or reduce fiscal risks. These should be addressed by implementing prudent macroeconomic policies and structural reforms that lower costs generally, and increase investment opportunities, potential growth, and job creation. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. Global economic and financial conditions are expected to remain volatile for the foreseeable future. In this highly uncertain environment, future decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second-round effects. As usual, the repo rate projection from the quarterly projection model remains a broad policy guideline, changing from meeting to meeting in response to new data and risks. This concludes our statement, and at this stage, I would then invite you to pose questions that you might have, and I will try and distribute it to the extent possible to members of the MPC who are connected remotely. Thoraya, are there any questions?
Governor, we have no questions from the media. If you can just ask them if they have any questions, if they could please type them as we have done previously. Thank you.
Of course, you have got an option, members of the media, of posing the questions via the chat function. Otherwise, you are welcome to come through the line and ask the question.
Governor, it appears we have no questions at this stage. I do have 2 questions from analysts on the line.
But we have got an analyst.
But we have an
tomorrow.
analyst, yes, Governor. Yeah.
Nothing coming through the chat function?
There are no questions from journalists at this stage, Governor.
Okay. I hope the Deputy Governors and the other members of the MPC can hear me. You have switched your microphone off.
I've just been advised that there is a question coming through from Bloomberg. It's not on my chat yet. There are no questions.
It's not coming through the chat.
I've got, but only from analysts, Governor. And as you know, we do have a call with analysts in the morning.
No, we have got an analyst call tomorrow.
Yes. Okay. I am being told that the journalists are now typing their questions, so if we could just wait for a second or 2, Governor. Thank you. Okay. Okay, I'm refreshing, there's nothing. I just have queries from analysts, Governor.
But Bloomberg is taking long to type. Okay, shall we then, if there aren't then questions from the journalists, then call this to the close?
Okay, Governor, I have the question from Bloomberg. Is this the end of rate cuts for the foreseeable future? What more can the SARB do to offset the impact of the virus?
As we have said, that any future moves by the SAB will be data dependent. There isn't an interest rate cycle, only the business cycle that we watch. What does this mean for the SAB? The SAB will continue to deploy its tools as appropriate to support the South African economy against the impact of the virus. We do believe that the steps that we have taken so far are yet to really filter through the economy because they were taken in such quick succession, and we believe that the transmission mechanism for monetary policy take anything between 12 and 18 months.
I have a question from the Wall Street Journal. How concerned are you about the calls by the ruling party to have the SAB help finance infrastructure projects?
We don't respond to political parties.
Okay. I have a question from Reuters. Is the SAB able to offer any longer-term guidance on interest rates in the way that the other major central banks have done? I've also got an addition to that is, given the severity of the Q2 contraction and the downward revision to your growth outlook and downward revision to this year's contraction, can you further explain why you did not cut rates?
The statement is very clear. It outlines exactly how we have analyzed this economy. And by the way, our expectations of the second quarter was for a 50% contraction. We have got 51% contraction. And as we had also stated, that although the contraction had been deeper, the output gap is remaining relatively unchanged. Because what this means is that even in spite of this contraction, there was actually a revision in the potential growth. What matters is the deviation of the actual growth from potential growth, which gives us the output gap, and that is what monetary policy is able to address. Forward guidance is a tool that is available for central banks. It's particularly useful when you are faced with a situation where you either say that I am going to keep rates high for long or I'm going to keep rates low for long. What we are saying in this statement is that as we have seen elsewhere in the world, monetary authorities and fiscal authorities have decided to gauge the incoming data and assess what this data actually means for the outlook, and based on that, they would then consider adjustments to policy. And that is exactly what we too are doing with any future moves by the SAB on the monetary policy front will remain data dependent. So as new data comes, we will assess the data and we will make the decisions as we deem appropriate.
I have two questions, Governor. Regarding the Fed's position to keep rates at near zero to 2023 and expectations of zero rates to come from the Bank of England, what room does this give the SAB to possibly move further downwards on rates if needed? That is from CNBC Africa. Then I have a follow-up question from Reuters. The MPC repeatedly calls for structural reforms to raise the potential economic growth rate. Has the government consulted the SAB in any way on the reforms needed to help lift growth? Those two questions are the latest. Thank you.
On the reforms, the government can take these steps without consulting us. If they do consult us and they ask us any specific issues that they would want us to deal with, we would look at that and consider it consistent with our mandate and offer our views as required. And but so far we have not had any approach from government that says what are your views on the structural reforms that are needed. And I guess it is because government knows exactly what are the structural reforms that are required. The thing about the interest rates in the advanced economies, just fits into, it's one of the pieces of information that we would consider. We will ask as to what that kind of stance by the advanced economies means for the global economy, one. Secondly, what does it mean for the future flow of capital to the emerging markets? And we would consider that and assess what that means for the South African economy, and if it has an impact on the South African economy, as we would expect it would, we would look at our tools and deploy them as appropriate to support the South African economy.
Okay.
Could you just check if the deputy governors have anything to add?
Any
The
addition?
other members of the MPC, do you have anything to add? Doesn't look like.
No, Chair.
Okay.
Thank you, Governor. I've got a follow-up from Bloomberg News. Governor, if the SARB is data dependent, how come rates have not been cut now, as both GDP and CPI forecasts have been revised lower?
How come the rates got cut in the previous 5 meetings that we have had? It's because you do not base decisions on yesterday's data. You base decisions on what you see as data in your policy horizon. And based on the data that you see on your policy horizon and the forecast and outlook that you have over the policy horizon, you adjust policy as appropriate. And there are times where, based on our forecasts, we felt that we have got to take steps where our own forecast suggests that policy should only be adjusted in 4 quarters' time or in 3 quarters' time, that we would bring those forward. At the moment, our forecast suggests that there is no need to adjust policy in the near term. But as it turns out, as new data comes through in this uncertain environment, we will analyze it, take a new view on the outlook, and deploy our tools as is appropriate.
I have a question from Inside Politics. How does the data that 3 million people lost their incomes during the lockdown influence the interest rate path?
Well, you know that when you consider the potential growth also involves the number of people that are involved. And another way of looking at the output gap is to actually also look at the gap between a natural rate of unemployment and the unemployment as it comes through. And there is no doubt that as jobs are shared, and at the moment we are not even sure of the extent of the jobs. All that we know is that lots of jobs had been lost, so I am not sure where you get your figure from. But jobs, we must understand, are an outcome of economic activity. And we could take a stance that would impact on economic activity on the cycle. And it is on the basis of the impact on economic activity that you have an impact on employment and job creation. So jobs, let's get these things clear. You cannot then say, as you asked, and say that I would like to have so many jobs. Jobs are an outcome of economic activity. And it is on this basis that as the economy opens up and you have got renewed economic activity, that you will have a better picture of what the job situation actually looks like. But MPC members, anybody who would like to add on to this? Okay.
Maybe if I can come in, Governor.
Rashad?
If there's a massive decline in incomes, obviously that will have an effect on consumption, and a decline in consumption obviously could lead to a decline in inflation. So at the end of the day, it all matters, but it's also partly related to the governor's view that it depends on where the business cycle is, what the state of the economy is. So the bottom line is that a massive decline in income we often interpret as a demand shock, and that reduces consumption and has a positive effect on inflation. Thank you.
Okay.
I have a follow. Thank you, Gav. I have a follow-up question from Reuters. Is there a trade-off the MPC has had to make between benefits of adjusting lending rates in response to short-term data versus the benefits of targeting a long-term average, a real rate? Did this come up in the MPC discussions at all? I also have a question from Business Day, Governor. How concerned were the MPC about the possibility of negative rates? Was the country's fiscal situation an issue?
Okay, that's an easy one. We do not have negative rates in South Africa. Our rates are still positive, and that is what gives us the space. And by the way, Chris Rashad, one of you must respond to the question, that follow-up question from Reuters about long-term rates versus short-term rates. And just to say that that last question about negative rates, that we have got positive interest rates. Yes, on a real basis, we might be marginally negative going forward. So our forecast for CPI for 2021, for example, is some 4%, and we have got a policy rate now at 3.5%. That says to you we have got marginally negative policy rate in real terms. But that is something that we can live with, because inflation is well contained at the moment, and we think that the economy could do with the kind of support that we are providing. And it's a very important point you have raised. The fact that we have got negative real policy rate on a forward-looking basis tells you that we are actually providing far more accommodation than is generally actually acknowledged. Chris and Rashad, who wants to take the first question?
Well, I'm happy to say something.
We're going to cross out of that now, the briefing there by the governor of the South African Reserve Bank there, Mr. Lesetja Kganyago, indeed giving us an update when it comes to the Monetary Policy Committee's decision. There you have it. It's our lead story this hour. The South African Reserve Bank deciding then to keep interest rates unchanged. The repo rate stays at 3.5%. It has dropped already by 300 basis points this year, or 3 percentage points. And the prime lending rate now sits, and still sits, should I say, at 7%. So that is your breaking news story this hour. I'm joined by Tendani Manchimuli from Liberty, as well as Johan Els from Old Mutual. And we'll be chatting and trying to unpack this decision a little bit more right after the short break. Let's take a break now. We'll be back right after this.
In response to the lockdown easing and to, I suppose, better news that the virus has been relatively limited in spread in South Africa. So as the economy starts to rev up again, that cash flow will continue to help. But also those low interest rates will start to change the way people view and businesses view both consumption decisions in the near term and, more importantly, investment decisions over the longer term. So, I think what's important about the rate path is that we've been able to provide quite a lot of support to the economy in the near term, understanding, of course, that interest rates are not going to solve the expansion and the output gap caused by the pandemic. Can't do that. It can just ameliorate it. And then at the same time, going forward, that rate path should support that recovery. And with inflation remaining muted, interest rates should be able to stay low. But of course, that's data dependent, and we'll have to see what how those numbers come out over time. But assuming that that rate path remains moderate, that should be very good for getting back up to pre-pandemic activity levels and then moving beyond it. Thanks.
Rashad Kuban, does anybody want to add?
Just a small point, Governor. I mean, just to add on what Chris says, I mean, if in your view, the trade-off you had in mind was that by reducing short-term rates at one level, longer-term rates or the 10-year yield becomes steeper, is there any trade-off there? If that's what you had in mind, I guess the point we ought to make is that, that the banks can determine, the SARB can determine the repo rate. It can influence maybe at times the long end of the yield curve. What it does in the short end of the curve has or may have an impact on the long term, but that's unpredictable. There are side effects sometimes, positive, negative. We have a short-term rate, and the long-term rate is kind of steepening. That could change maturities, borrowing in the economy. But it's not, obviously, the trade-off is not an easy trade-off. The important thing is that the central bank plays a very important role in the short-term end of the rate. Its credibility plays a very important role in the part of the long-term rate that takes into consideration the inflation premium, the other premium, risk premiums that are well beyond our control. Thank you.
Can we take the last round of questions?
Thanks. There are 3 questions. The one is directed at yourself. It's from CNBC. You have repeatedly said that monetary policy alone cannot grow the economy. What are the latest conversations between yourself and the finance minister, and how fiscal policy can play its part in growing the economy? How often have you and the finance minister met since the lockdown, either virtually or physically? I have a question for Deputy Governor Naidu. Can you tell us about the latest tweaks that were made to the COVID-19 loan guarantee scheme to encourage more take-up of the loan? The President mentioned last night that there were additional tweaks. And then there's also a question, from Business Day as a follow-up. What does the Governor think of the Fed's approach, where they said they will act only after inflation hits a particular target for a while? Could this be a model for South Africa? Governor, if I can just also squeeze in one more from Business Day. Can you, it's a follow-up on an earlier question on the extent to which the fiscal situation was a factor in the MPC's decision. That will be a wrap of the questions. Thank you.
Okay, DG Naidu, shall we start with you with the loan guarantee scheme? And
sure. Thanks, Governor. There have been several tweaks to the loan guarantee scheme, I think largely positive. The main tweak is that the 300 million rand limit on turnover was lifted, so companies of any size can apply, although there is a loan cap of 100 million in place. The second tweak is that whereas the original loan was merely to cover existing operating spending, the new loan includes a provision for what's called a business restart loan. So if businesses need capital or liquidity or money to retool or to redesign their premises or to invest in PPE to reopen, that's covered. There is no explicit need for the banks to hold additional surety in terms of the scheme. If banks deem the need to hold surety, then banks can, but there's no explicit need in terms of the design of the guarantee. And also the last change is that whereas previously there was a 3-month payment holiday as part of the loan, now there's a 6-month payment holiday. Chair, I think all of these are positive developments. I think that they will stimulate businesses to reopen, to restart now that the economy is beginning to open up. And I think it'll contribute at the margin to supporting increased economic activity, Chair. Thanks.
Okay. Fiscal situation, wrong forum. I think that the Minister of Finance will next month say what the fiscal position is. It is that stance that would be announced that we will take into account in our future decisions. As things stand, we do not know what that stance on fiscal policy is going to be. And that links back to the conversations with the Minister of Finance. I have not spoken to him for 10 days because we do not speak before the MPC. And, but we have had a range of conversations. I can't give you a number. We have had lots of virtual meetings, and we have had 2 physical meetings. But for the rest, we talk on the phone. And sometimes just picking up a phone and talking to somebody has got a better effect than sitting in a room. But we talk as and when it is necessary. Obviously, in the run-up to the finalization of the South African borrowing from the IMF, we had to have a lot more interaction on the letter of intent before the 2 of us could sign us. We talk all the time as and when it is necessary to do so. Comment on the Fed's approach. I'm sure if you ask the Fed about the approach of the SAP, they will tell you that they will not comment on the approach of the SAP because every country will adopt an approach that fits its circumstances. And we have got, they had an inflation target which is 2%. It says it's asymmetric, it's either whether below 2% or above 2%. We have got a range of 3 to 6, and we aim for the midpoint, and that gives us the flexibility within the 3 to 6%, and that is the approach that we had found to have worked for South Africa. Yes, that has dealt with all the questions. Thank you very much, ladies and gentlemen. That brings us to the end of our press conference.